When the Fed says they're keeping rates higher for longer, what does that mean to you?
That means that companies that have been limping along, refinancing at very low rates, are no longer going to have that option. What happened is the Fed said, we're going to leave it longer because we weren't getting the reaction we needed from the first rate rises that we implemented. So when we leave them higher, it gives companies less and less ability to keep motoring along on a very, very low debt payment. Maybe the market's not going to lend me any money this time. Maybe my balance sheet's not looking quite as good, and maybe my rates are going to be much higher, which means it's going to be harder for me to be more profitable, which leads generally to layoffs.
Starting your route to retirement.
Welcome to the Guided Retirement Show. I'm your host, Dean Barber. Today, for the second time here in 2023, I have Garrett Waters, the CEO and Portfolio Manager for Anchor Capital. Garrett is going to give his thoughts on the stock market, the bond market, the economy, the outlook for the remainder of 2023, and the outlook for 2024. Please enjoy my conversation with Garrett Waters. All right, we've got Garrett Waters with us today. He is the CEO and Portfolio Manager at Anchor Capital. Garrett, you were on last time, February 2023, here on the Guided Retirement Show, episode 82. Welcome back. Glad to have you here.
Thanks for having me, Dean. I appreciate the opportunity to do it again.
Absolutely. So, Garrett, for those people that are not familiar with you, why don't you just give us a brief background so that when you're giving your opinion on where you see things today, people will give it some credibility.
So, Anchor Capital, you had mentioned I'm the CEO, I'm PM over here, our Portfolio Manager at Anchor Capital. We run 3 risk-managed mutual funds, and all we focus on is risk management. We don't really try to isolate or look at things in a different way. We focus on risk first, and we feel like if we get the risk right, we'll get the return right.
Prior to becoming CEO at Anchor and Portfolio Manager Anchor, what did you do before that?
Well, I started, if you want to go way back, but I started out at JP Morgan Investment Management in New York when I came out of school, and then was recruited over to Barclays Global Investors and helped launch all the iShares. And why is that important? Because it really gave me a view of active management and passive management, and it also helped pave the way for the way Anchor Capital does things today. We don't use any single names in our portfolio. We only use ETFs, and we dynamically hedge those ETFs with futures around our core position.
So you don't have a concentrated position in a stock like Apple or Microsoft or NVIDIA or any of those?
As a risk manager, there's too much risk in a single name, we believe. We also like to look at markets from a more top-down, and we look at things in 3 timeframes. So we break those macro ideas into short-term, intermediate-term, and long-term, and we do that across all 3 of our mutual funds, and that gives us the best risk-adjusted return and performance over time.
So when you say long-term, give me a time frame there. Same thing with medium and short-term. What are your parameters there?
So, for example, we'll look at the 6 to 9 month, or even as far out as 12-month time frame in the long term. The intermediate term is going to be more focused on the 3 to 6 month. And the short term is really looking at mean reversion. That can be anywhere from a day to a week.
Okay. So very dynamic then.
Very dynamic, yes.
You and I had the pleasure of having a conversation here just a couple of weeks ago, and you were giving me your thoughts on what you see from a macroeconomic standpoint, from a market standpoint, both equities and fixed income. So I wanted to bring you on here to the Guided Retirement Show to have you share your thoughts of what you see. You told me that there were a few things out there, maybe multiple things that have you concerned about some risk that is on the horizon. And I think that, when people kind of tend to look at, well, here the S&P 500 as of the day that you and I are doing this podcast is probably up in the 15% range, but that's on the cap weighted S&P 500. The equal weight's actually negative year to date. So people don't know about the equal weight. They only look at the S&P 500 that's broadcast on the nightly news, and you see it everywhere online. So people, I think, are lulled into a false sense of security here, according to you.
Well, we don't, what we try to do is really focus on that long-term price appreciation, which tends to happen over time, and avoid the short-term price dislocations that can really shake people out of their plans. So what does that mean? let's take a look at the S&P 500's journey for 2023. And when you look at it, we started off the year pretty strong, and then we had two very large bank failures. And the S&P actually was approaching negative territory in March. So you started with that first quarter almost going into negative territory. And this market has been a story of liquidity. And so where does the story come in? The whole market's return happened basically from March 15th to July 31st. And that was because of the liquidity program that the Fed put in place to save these banks. So where the Fed was saying they were going to really raise rates and dry up liquidity, you can see that they sparked it again to basically save our economy and save our banks. People were going to lose their deposits and they were going to lose all their money because these banks had deposits well in excess of the FDIC insurance rate of $250,000. So they stepped in and secured all those depositors and kept the market from really, in my opinion, from going off a cliff. So now that liquidity in July 31st has started to dry up and the market has started to really whittle its way down from July 31st with more volatility. So we'll see. We have about, 2 months to go to the end of the year, and we'll see where the push is. We got through the earnings season, and what you're hearing now is the rates are really starting to have an impact in the investor portfolio. So had we not stepped in with more liquidity in the middle of March, we probably would be sitting at a very different outcome, even though we still lost two very large banks in the meantime.
Yeah, and I think the S&P 500 actually fell into correction territory, which is defined as a drop of 10% or greater from a previous high. At the same time, the NASDAQ went into correction territory. Both of those happened in the third quarter. Coming into the fourth quarter, we're seeing some reprieve. And, just last week, we had one of the best weeks that the markets had all year long. And so is that a catalyst of the Fed saying, okay, we're going to take a pause here, or is that a sign of things to come that, maybe the Fed's done and it's off to the races again?
Yeah, let's dissect that a little bit because it was a very big week. And really what was said, the Fed said, we're not going to raise, but we're going to keep rates higher for longer and continue with quantitative tightening at full speed. Okay. And then you got a horrible jobs report, which means that people think that the Fed's going to cut. And as these economic indicators start to add up, you start to see this move over. And you brought up an interesting point about correction territory. If you look at the regional banks, they're still in a crash, as defined by down about 30% on the year. So where people were really worried at that March timeframe has not recovered at all and is actually sinking deeper into drawdown. And you're seeing that also across the small caps. Small caps are people are so focused on the Magnificent Seven, they're taking their eyes off a lot of different markets, which we watch. So emerging markets are approaching negative for the year. Europe's in a recession and approaching negative for the year. And how long will we be protected on our shores? Now, the large cap stocks are still hanging in there, but the small caps and big caps have really been beaten up. So there's a lot to look at. There's a lot of opportunity across different asset classes than just the S&P 500.
Yeah, let's talk about the price dislocation that's occurring right now from that Magnificent Seven to the rest of the market. I mean, you've got some mega cap companies out there, especially the oil giants, that their price to earnings ratios are 10 or below, and yet you're, sitting here with Nvidia over 100, Amazon in the mid 70s, and the list goes on and on. So the price to earnings ratios on that Magnificent Seven are totally dislocated from the price to earnings ratios on what we consider maybe our staple type of stocks.
You're starting to see real estate go negative, like an IYR is negative on the year, and the financials are following along with the large cap financials are following along with the regional. So you have a lot of issues. You would expect the large cap or the Magnificent Seven to do well because of the liquidity that was injected into the system. That's where the money is going to flow. And then as that liquidity starts to dry up, you'll see it outside of the Magnificent Seven. You've already seen it starting to dry up and the returns starting to fall down. And then eventually you'll probably start to see those stocks follow. if it gets more serious.
So when the Fed says they're keeping rates higher for longer, what does that mean to you?
That means that companies that have been limping along, refinancing at very low rates, are no longer going to have that option. And that's why you're seeing that in the regional banks. The regional banks, why do we talk about that? That has the largest exposure to commercial real estate, which I'm sure everyone's heard about in the press. Those loans are all going to need to be refinanced the longer the Fed holds rates higher. So what happened is the Fed said, we're going to leave it longer because we weren't getting the reaction we needed from the first rate rises that we implemented. So when we leave them higher, it gives companies less and less ability to keep motoring along on a very, very low debt payment. So now I have to go to the market, and maybe the market's not going to lend me any money this time. Maybe my balance sheet's not looking quite as good, and maybe my rates are going to be much higher, which means it's going to be harder for me to be more profitable, which leads generally to layoffs.
Interesting. Okay, so let's talk a little bit about the wars that are going on in Gaza and in Ukraine. Do those wars have any impact on your outlook for interest rates or inflation or a stagnating economy with potential inflation still there?
Well, the interesting part is both of those countries are very, I'd say, focused on energy. So Russia, you saw the tariffs, and you saw that country get isolated from doing business with others very quickly. And with Israel, obviously in the Middle East, you saw oil come up. And again, those shortages people were anticipating. What's interesting now is you've got a short pump, and then in the price of oil, and then oil is starting to come off. What should you be thinking in that scenario? You should be thinking that demand is coming down. So it's not so much that there's shortages, there's no demand for the product or oil. And why is that a problem? That tells you transportation, meaning how our goods and services are moved, are not being moved at the pace they were being moved, which affects China directly and affects Europe and affects the United States. So you want to see those transports really humming and use of oil really going, because that means people are building, expanding, and transporting goods and services. So now it's becoming more a function of demand than just the function on the commodity. And so you're starting to see those countries, the Russias, the Middle Eastern, like Saudi Arabia, keep their production cuts high and elevated, and potentially going to add more cuts because they can see that demand is falling off and they want to keep the price high.
So as we head into the end of 2023 and into 2024, do you still continue to see a headwind for fixed income, or do you see fixed income stabilizing and maybe there's a slight tailwind coming over the next 18 to 24 months? And the same kind of question with equities themselves.
Definitely, I'll take the equities first. Equities, there's going to be a big tailwind, and everything is a function of rates. So just like it's going to affect fixed income, that lag effect we talked about with the rates is going to start to have an impact on equities. And again, you're seeing it in the usual suspects like real estate and financials. And then what does that mean for fixed income? People think it's peaked. The Fed is going to keep it where it is, and then we're going to again see, is it a function of demand? How much do people want bonds over stocks? So as stocks start to fall, their dividend yields might become more attractive, but right now fixed income holds the upper hand.
And so if the Fed keeps rates higher for longer, obviously they're not controlling the 10-year Treasury, but we saw third quarter, we saw the 10-year Treasury move from 4 to 5%. And then in the last week or so, we saw it move from 5 back down to around 4.6. So, it was a huge headwind for fixed income in the third quarter, but the Fed doesn't set the 10-year Treasury rate. So what's causing all of that volatility in the 10-year yield?
And that's a really good question and a very hard one to answer. our view is when we're looking at fixed income, those swings you're seeing are a function of volatility, but they're a function of people looking out 10 years and 30 years and wanting to be compensated for the risk. So you saw a big move in those indexes or in those yields because people were looking at what we were facing as a government, too much debt and a potential shutdown looming. So if you want me to look out 10 years and 30 years and take risk, I want to be compensated for it. So I'm going to ask for more yield. And as there's more certainty from the Fed, which has been lacking, and credibility from the Fed, you're going to see more volatility in rates. That volatility in rates is going to be very hard for a lot of people to navigate that are dependent upon rates for borrowing costs.
So as a risk manager, Garrett, heading into kind of some headwinds for equities and maybe a little bit better sailing for fixed income, what do you do right now?
As a portfolio manager, we always evaluate the risk. And so when we're looking at risk here, when risks are elevated, we have the luxury of not being directionally set, meaning we don't just bet things are going to go up or we don't, to make money. So when you look at your traditional equities, they have to go up for an investor to make money. And with fixed income, you're expecting really to kind of clip coupons and have very, very low volatility. We at Anchor Capital have the ability to transition and be dynamic with our portfolios. So if it's a more offensive environment or a growth environment, we can position our portfolios more in line with equity growth. And as it becomes a more defensive or where equities are positioning to do worse, we can actually hedge those positions and actually get more in line to make money on the downside.
Okay, very good. We appreciate you joining us here, Garrett. So just any kind of parting wisdom for our listeners and viewers here on the Guided Retirement Show?
Sure. Well, as any retirees listening, you get very nervous when volatility approaches. And so as that volatility approaches, you'll see it most in your stocks. And so the best way to limit that volatility is by putting a risk-managed strategy in the middle between your stocks and your bonds. It will smooth out your returns and give you a much smoother journey to your retirement.
And maybe even keep you on track and get rid of some of those emotions.
That's exactly what it is, because as much as we like to say we're disciplined, when that volatility starts to come up, investors jump off a well-defined plan that an advisor sets to work, and it causes them then to be out of sync with what their plan is, and then they don't know when to jump back in, and then they wind up missing a lot of great return that they otherwise would have had if they stuck with the good plan.
Good advice, Garrett. Thank you again for being part of us here on the Guided Retirement Show, your second time on, and I'm sure it won't be the last. Enjoy the rest of your day, and thanks for taking the time.
Thank you, Dean.
I hope you enjoyed my conversation with Garrett Waters, CEO and Portfolio Manager at Anchor Capital. That was, in fact, our 99th episode of the Guided Retirement Show, and we have a very special show coming up for episode 100. Bruce Godke is a advisor, was a partner of mine for a number of years, and Bruce is going to embark on the next journey of his life. He's going to start with an around-the-world cruise with his wife, and when he returns, he's going to be heading up our non-financial retirement planning, and so it's all about things that you need to know heading into retirement that are non-financial related. So please, if you're not subscribed to the Guided Retirement Show, make sure that you do so. If you're watching us on YouTube, make sure you hit the bell icon. That way you get notified when that episode comes out. That will be episode 100 with Bruce Godke.
Starting your route to retirement.
Thanks for watching. Subscribe here to get the latest from the show. Also, be sure to leave a comment and share this episode with your friends.
Investment advisory services offered through Modern Wealth Management, LLC, an SEC-registered investment advisor.